Okay, good afternoon, everyone. I'm Stuart MacArthur, your host from Cooee Group. Welcome to this exciting webinar on the federal budget, end of financial year planning, and upcoming changes you need to know about that are taking effect on July the 1st. As we approach the end of the financial year, it's a crucial time to take stock of your financial plan and to plan for the future. With the recent federal budget announcements, there are some key considerations to keep in mind that could optimise your financial strategy. In today's webinar, we'll be diving into the detail of the 2024-25 federal budget and its potential impact on your finances. We'll also be exploring effective end of financial year planning strategies and providing insights into the changes coming into effect again on July the 1st. To guide us through this informative session, we have Andrew Grinsell, our Head of Wealth at Cooee Wealth Partners, with us today. Welcome, Andrew.
Thanks, Stuart. Thanks for everyone who's joining us today.
Thank you for joining us today. Now, what we'll cover are the highlights from the 2024-25 financial budget, as I said previously, and what this particularly means to client strategies, economic impacts of the 2024 budget, end of financial year strategies, and importantly, superannuation, personal tax rate, and other changes commencing on July the 1st, 2024. For those of you who are new to Cooee, I'd like to give a quick overview of the group and the collective expertise that brings. Imagine navigating a financial journey that with clarity, of course, confidence, and your trusted partner by your side. And that's what the Cooee Group difference makes. We're not just another financial service provider. We're a collective of passionate experts dedicated to one thing, helping you achieve your financial goals, whatever they may be. Think of us as your financial co-pilot. We specialise in wealth planning, mortgages, accounting, and property strategies. You might ask what sets us apart. We collaborate seamlessly. Our different specialities work together, offering what is really a truly holistic solution. We tailor our approach to your unique needs and goals. We bring experience. Our qualified specialists are here to guide you every step of the way. And of course, transparency is key to everything, so open communication, so you always know what's happening. Now, before we get started with the particular presentation and invite Andrew in to start talking about the 2024 budget and 2025, how that affects you, I do need to read through this disclaimer. And I will cut through it. So as I'm reading through it, please take note and read through it yourself. The information presented in this webinar is for general information purposes only, and obviously not considered as personal advice. Before making any investment decisions, you should consider seeking professional advice from a qualified financial advisor. Please note that past performance is not necessarily indicative of future results, and any investment involves risk. Investment involves inherent risks, including capital loss, volatility, liquidity risk, inflation risk, credit risk, interest rate risk, currency risk, regulatory risk, and economic risk. So without any further ado, I'd like to hand it over to you, Andrew, to take us through this exciting budget.
All right, excellent. Thanks for that, Stuart. Look, we'll go a bit deeper into the key issues that are most likely to impact our clients and those who are on the webinar today. But what we'll do is we'll just start with a high-level recap of what was announced last Tuesday night. So for the first time in a while, superannuation was actually left relatively untouched. The only real changes that we're seeing for superannuation are around super contributions now being paid on paid parental leave. And there's also a bit of a change coming into effect soon around the timing of superannuation contributions. To help with the cost of living challenges, the government's announced energy bill rebates, increased rent assistance payments, cheaper medicines, increased job seeker payments, and a bit more flexibility for carers to be able to work and study. So as we can see there, we've got caps on the indexation of student loans, so that's the HECS or HELP scheme, and also the deeming rates for social security, which is important for those who are receiving sort of age pension entitlements, will be frozen at 0.25 and 2.25% until 30 June 2025. Now, we'll go into these in a bit more detail as we move through it and explain what that actually means for our clients. But before we do that, I just want to talk about the economic impact of the budget. So look, it provides a bit of support to the economy through broader tax cuts and some modest cost of living relief. These measures really should improve the growth prospects for the Australian economy, which in turn really should flow through to better earnings growth for the Australian corporates. So if we do see that improved earnings growth, and then along with the fact that Australian equities are relatively attractively valued compared to global equities, it does mean that there's support there for Australian equities to perform quite well. Now, we're also looking at net migration, 395,000 this year. Now, that's expected to fall down to 260,000 next year. That results in Australia's population growth dropping back from a peak of 2.4% per annum that we saw in the 2022-2023 financial year, moving back to about 1.4% per annum moving forward. Obviously, that's quite important when we see the crisis that we've got at the moment around rising rents, lack of available properties, and so forth, and also just not enough housing being constructed. So as far as the economists have commented on the budget, Shane Oliver of AMP noted that the current year budget did benefit from higher income tax collections than what was originally forecast, and that was largely thanks to strong jobs growth and higher commodity prices. Really a case of good luck rather than good management that has triggered that budget surplus. Now, the new stimulus measures that were announced in this budget do create the risk of increased consumer demand. That means inflation, potentially keeping interest rates higher for longer. We're also seeing government support for higher wages in some sectors, which does add risk when we've got wages growth already running at what is the maximum level for the inflation target to be achieved. So if wages growth stays at the current level or increases, the ability for the RBA to get inflation back down to between 2 and 3%, it's quite challenging. It's not really supported. We do need to see wages growth come off a little bit for that inflation target to be hit. Now, we are also seeing medium-term structural deficits, which does mean that there is a bit of vulnerability there if the economy does weaken, as no money's really being put aside for a rainy day. Now, we do have a chart on the screen there, and what it shows us in the red line is government spending as a percentage of gross domestic product. And what we can see there is that spending is settling at a level that is still well above the pre-COVID level there. So we're looking at government spending, instead of being sort of 24.8, 24.9% of GDP as the average pre-COVID, we're now looking at closer to 26%. So that does mean a bigger government, and that has some risks there around productivity growth over the medium term. So it is a bit of a concern. There is positive, however, which is that revenue could actually be higher than what the government is forecasting, and that's because the government has assumed the medium-term iron ore price to be around $60 per tonne. It's actually over $100 a tonne at the moment. So that means that if the tax collections are rising from that higher than what's forecast, we could actually see lower deficits than what were forecast last week. So there is some room for upside, which is good. All right. Now, let's have a quick chat about those superannuation changes that are coming into effect. So the government will pay superannuation on the paid parental scheme at the rate of 12%. Now, from 1 July, the super guarantee contribution rate is going to 11.5%. From 1 July 2025, it's going to go up to 12%, and that's where the paid parental leave scheme is going to start. So it's just starting at that terminal rate that super guarantee contributions are meant to get to. Now, paid parental leave payments, the value of those is set at the national minimum wage of $882.75 per week. So what this proposal is going to do is it's going to help normalise paid parental leave as a workplace entitlement. It should narrow the gender gap when it comes to superannuation balances. It won't completely close it, but it'll help. And it should also reduce the impact of taking parental leave that has on retirement income. So it also builds upon some legislation that is yet to be passed, which is to gradually increase paid parental leave up to 26 weeks by July 2026. All right. There is also another measure here that should impact most, if not all, of our clients who are currently working. Those who are retired are not going to be impacted by payday super contributions, but for those who are still working, what we've seen since 2003 is employers have had the ability to make superannuation contributions only quarterly. So that means that the super contributions historically don't have to be made at the same time that wages are paid or salaries are paid. So that means that we see a lot of our clients get their super contributions as late as 28 days after the end of each quarter. But there's often a bit of a break in the pattern there. Some employers will look at super accounts for our clients and they'll be getting weekly contributions. Then all of a sudden we'll stop for 2 months and go to quarterly. It's all over the place for some people. So it makes it really difficult for us and the clients to be able to work on a superannuation contribution strategy where they're trying to maximise their contribution caps when the employer has got such flexibility around when they make their super contributions. Importantly, super contributions are deemed to be made and they count against the contribution cap when the fund receives it, not when you actually earn those monies. So, for example, if you've got an employer that's paying quarterly superannuation contributions for you, and we're in the June quarter right now, you could start salary sacrificing, thinking that that's going to increase your super contributions in the current financial year. However, your employer is not obligated to contribute that salary sacrifice to your super until the end of July. So by bringing this forward and ending up in a situation where we're going to have payday superannuation contributions, it's going to be a lot easier for our clients to be able to plan their superannuation contribution strategy and make use of those caps effectively. Right. Now, we want to have a look at some other changes that are coming into effect for superannuation from the 1st of July. Now, these aren't all specifically budget-related measures. These are other things that have been sort of introduced over different periods of time, but very important for financial planning moving forward. So what we've got here in this table is the column in the middle is the current financial year, and then what are we seeing from 1 July 2024 for the FY 2025 financial year. The rate of superannuation guarantee is going up from 11% to 11.5%. The concessional contribution cap. So concessional contributions are all those contributions that are either made by your employer or contributions that you've made personally and intend to claim as a tax deduction. So that cap is going from $27,500 up to $30,000 a year. We're seeing the non-concessional contribution cap. So this is any contribution you make to super from money that's already in your bank account that you've already paid tax on. You're not claiming a tax deduction for the contribution. That's going from $110,000 a year up to $120,000. So a bit of an increase there. We also have this thing that's called a 3-year bring forward rule. And that's where you can basically say, well, look, this financial year, I want to make a superannuation contribution and I'm going to use my entitlements that I otherwise would have had for the next 2 years, and I'm going to bring them forward to today so I can get all the money in one hit. That's 3 times, so that cap becomes 3 times the annual non-concessional contribution cap. So we're going from 330,000 as the limit there up to 360,000. For those who are selling an eligible asset that gets the CGT relief on the sale of a business, contribution cap around that, very generous, going from 1.7 million up to 1.78. Limited use and scope for that one, but if you are a small business owner and you are looking at your exit strategy, certainly an opportunity there. And last but not least, we have the government co-contribution. So the threshold at which the maximum co-contribution applies is going to go from 43,445 up to 45,400. And then the threshold at which you lose any entitlement to the government co-contribution is going to go from that 58,448 up to the new amount of 60,400. So overall, the impact for superannuation contributors, people who are pre-retiree, who've still got assets to transfer into super, is just that it does require a rethink of what your superannuation contribution strategy is. And also think carefully if you are going to trigger that bring forward arrangement. And I'm going to use a case study just to illustrate that one. So what we've got here, Julie, age 64, she's received $500,000 as an inheritance, and she wants to use that to be able to boost her retirement savings. So what she could do is make a contribution in the current financial year using that bring forward arrangement. $330,000 would go into super. However, that would prevent Julie from being able to contribute to super in the FY 2024 and FY 2025 years under that non-concessional contribution amount. Concessional contributions are fine, different cap. FY 2025 and 2026, also no contribution. So should only get 330,000 in. However, with a bit of careful planning, if you contributed 110,000 this financial year and decided not to go over the single year cap and actually wait until next financial year to trigger that, which could be as early as doing that contribution straight after the 1st of July, we can get 110,000 in and then 360,000. That actually allows $470,000 in total to get into the superannuation environment, potentially over the next 2 months, as opposed to 330,000. So the key message here is just be really careful around after-tax contributions and when to trigger that bring forward arrangement. There are other restrictions that come into it as our clients get older. There's age-based restrictions and what have you. So by all means, you need to do a little bit more research around this, seek financial advice before executing, but certainly plan around it. All right. I also want to just do a strategy here, or a case study around some concessional contributions. This is one where we've had this sort of scenario come up for a few clients in the last couple of months. So let's take Jack, 58 years of age, just sold an investment property and has a taxable gain of $150,000. Now that's net of all the stamp duty, conveyancing costs after applying the 50% discount on capital gains. So the actual amount that tax has to be paid on is $150,000. Jack also earns $110,000 per annum from employment, but doesn't make any extra super contributions. So no salary sacrifice, no personal concessional, just always receive the super guarantee contribution amount. And Jack has $300,000 in super. So what Jack has available is what's called a carry forward unused concessional contribution. Bit of a mouthful, that one, but what it basically means is over the recent years, we can see in 2018-19, back when the cap on tax deductible concessional contributions was $25,000 a year, Jack only contributed $10,450, leaving an unused amount under the cap of $14,550. Now that trend's continued on. Contribution caps have gone up over time. The super guarantee contribution rate's gone up over time. But at the end of the day, we're in a situation where Jack has got $91,500 worth of unused carry forward concessional contributions. So what Jack can do is could do nothing, could just take the gain, not make any super contributions. He'd have $110,000 of employment income, $130,000 of capital gain. That means total income of $240,000 on which tax needs to be paid. He hasn't made any super contributions to reduce the tax payable, so he's got to pay tax on that $240,000. The tax on $240,000 of income is $85,927. It's quite a substantial amount. However, if Jack decided to contribute $91,500 super, which if we go back is the unused amount, what we can see there is the taxable income comes down to $148,500. Now, the tax on that income is quite a lot less. It's $42,982. However, there is still tax to be paid on the super contribution. So when you contribute money to super and claim it as a tax deduction, there is a 15% tax rate applied to it. If you're earning over $250,000 a year, there's an additional 15% tax on that again. In this case, however, Jack's total income's $240,000, so that additional 15% doesn't apply. So the combined tax rate under this strategy, $56,707. So Jack's saving $29,220 just through using superannuation contributions to manage that tax liability. All right. Importantly, that ability to do so only exists until you have $500,000 in super. If you have over $500,000 in super as at the 30th of June on the prior financial year, these contributions are not available. So again, there's a few little eligibility criteria that need to be met. So we do recommend that appropriate due diligence be done around that, and of course seek personal financial advice before implementing such a strategy. All right, personal income tax rates. So modified stage 3 tax cuts come into effect on the 1st of July. Now, these aren't, they're a little bit different to what was originally proposed under the coalition government. We've seen the tax cuts for high income earners be reduced a little bit more in favour of middle income earners. What it means is that lower income households will receive a tax cut, which is likely to support consumer spending. And the reason behind that is lower income households do have a higher propensity to spend rather than save. So under these tax cuts, the 19% tax rate is going to go to 16%. We can see that here in this $18,000 to $45,000 band. So that goes from 19 down to 16. The 32.5% tax rate comes down to 30%. That tax rate, however, now implies instead of cutting out at 120, it actually goes all the way up to 135,000. So that means more earnings being captured at a lower tax rate before going up to the 37% tax rate. 37% tax rate's unchanged. However, it now applies up to 190,000 of income, whereas before it capped out at 180. And then the tax rate above 180 is unchanged. Now, what does that actually mean for somebody on $50,000 a year? They're going to save $929 a year in tax. On $100,000 a year, you're going to save $2,179. On $150,000 a year, it's $3,729, and on $200,000 a year and above, saving $4,529. Now, what do you need to do about this? If you have any tax deductions, so expenses around investment properties, income protection policy payments, things like that, you might consider actually paying those premiums this financial year if you can, because then you can actually claim the tax deduction this year when the tax rates are higher. Capital gains tax events, redundancy payments, anything like that, you might actually try and defer it until next year when the tax rates are lower. The overall impact of this, however, is that for the average income earner with the average mortgage, this is the equivalent of getting 3 25 basis point interest rate cuts. That's the impact on cash flow. All right. Social Security, I'll move over this one quickly, just given that most of our clients tend not to qualify in this space. However, from 1 July, super guarantee contributions, that should have sat under super, but anyway, going from 11 to 11.5%, as we spoke about earlier. Rent assistance going up by 10%. Deeming rate, so that's the amount of income that Centrelink assume or estimate you're receiving on your investments, is going to be locked at 0.25% for at the lower threshold, and 2.25%. So that's still quite actually somewhat below what most people are now getting in bank interest. So the assumption around what you're actually earning is less than the actuals if you've got your money in a decent earning investment. Temporary freeze on the indexation of the pharmaceutical benefits co-payments. And then also, well, what are the impacts around this? It just means that the higher yields we're now seeing on term deposits, interest rates, and other investments shouldn't harm anyone's ability to qualify for the age pension or the Commonwealth Seniors Healthcare Card entitlements, and also medicine shouldn't be impacted by the rising cost of living that we're seeing. All right. Now, if anyone's got any questions, please send them through. Stu, I think we might have one already. You're on mute, by the way, Stuart. Stuart, I don't know if you can hear me, but I think you're on mute.
Lovely. Yeah, there's some noise in the background, so I switched that off. Look, yeah, if anybody does have some questions, please do send them through. Remember that Andrew's gone through this relatively quickly and covered most aspects of the budget. If there's anything in there that affects you, anything you want to find out more about, please, of course, consult with your wealth partner, and they're more than happy to discuss it in more detail. But yeah, if you have any questions, please do send them through. I do have one here from Michelle. Is there a benefit to delaying the settlement for the sale of my investment property until after 1 July to benefit from the new tax rates?
Yeah, look, that's a good question, and that one actually comes up quite a bit. So look, there's no blanket answer. So if someone's earning under $190,000 per annum, the new tax rates will result in some savings if the gains incurred next year rather than this year. One thing to be careful of, however, is that there's quite a substantial misunderstanding we often see around capital gains and when the events actually occurred. So the thing with the capital gains tax event is it actually occurs when you enter into a contract. So, for example, on the sale of a house, the capital gains tax event is actually the date on the contract rather than the date of settlement. So if you're signing a contract today and settling after the 1st of July, that capital gains tax event is actually in the current financial year. Now, that can actually create some substantial challenges. So if we go back to that example we had of Jack earlier, who sold an investment property and wanted to make some tax deductible superannuation contributions, if Jack needed the sale proceeds to make the contribution, we potentially have a problem if the capital gains tax event occurs this year, but we don't have the cash until next year to be able to do anything about it. So I see some people try and get a bit, I think they're being smart by trying to stage that that settlement so that it falls into next year, but it actually can do more harm than good. So just be really careful around that one.
Okay, thank you. Andrew, look, I know we had some issues last time with Q&A, with questions and answers. I can't actually see any more questions coming up. So from my point, It looks like you've covered everything thoroughly.
Yeah, I think so. Either that or the topic of budgets, not as exciting as investments. So, but look, it's important. Strategy and getting these things right, we really like to focus on it because they're known outcomes. Investments, obviously, we're working on sort of probabilities and unknowns, whereas when we're working around things like tax strategies and super contributions and that, we have a known outcome from those strategies we're implementing, and they're quite important for clients. So if anyone does have any questions that arise out of this, please just reach out to your wealth partner. If you're not yet a Cooee group client, please reach out via the contact us on the website, and we're happy to always have a chat and help wherever we can.
Absolutely. Thank you for joining us, and we look forward to another edition of these episodes, and we'll bring one shortly to you again. But thank you, everybody. Fantastic. Have a good day.
Cheers.
Thanks, Andrew.
Stuart. Thanks, everyone. Bye.